I'm Matt Kadnar from the Nebo Wealth team. A piece came across my desk recently by Cliff Asness of AQR. It's entitled 2035, and Allocator looks back over the last 10 years. It's basically Cliff saying today, okay, I have a portfolio. What could go wrong over the next 10 years to cause my returns to be subpar? It's a very good rhetorical device. We would call that a pre-mortem, basically trying to understand what could go wrong, and it is a very good risk management function in any investment process. So Cliff writes, sitting here in the year 2035 and looking back at our endowment's return for the last decade is not a pleasant task. World markets have been subpar, and our performance relative to those world markets has simply been terrible. Hard times are never pleasant, but they do have one upside. We can learn from them. Goes through the different asset classes. Starts with U.S. equities. First, it turns out that investing in U.S. equities with a cyclically adjusted P/E in the high 30s yet again turned out to be a disappointing exercise. After being left for dead by so many U.S. investors, the global stock market did better than U.S. stocks, actually returning normal returns of 5 to 6% over cash. It turns out the U.S. really did have the most profitable, innovative, fastest growing companies, but paying an epic multiple for those U.S. companies compared to the rest of the world mattered more than we thought. It turns out international diversification did eventually work, and there was indeed a price at which European stocks made sense. And that's news to us. He goes on to talk about value stocks. He says it's an old-fashioned idea, but the idea of buying value stocks worked from 2025 to 2034. But sadly, by 2025, we had fired all our value managers, despite the spread between value and growth still being exceptionally high, especially in the super expensive U.S. And he goes through and he talks about cryptos and privates and liquid alts. But the point Cliff is making, I think, is a lot of times when you make an investment, if that investment feels good, that's the time you should be most concerned, because if it feels good to you, it likely feels good to a lot of other people, and that means that is going to be reflected in the price. And that good feeling will turn out to be less likely so as you project that forward. And conversely, some of the biggest trades we've ever made, the most successful trades we've ever made, have been decisions that have really been gut-wrenching. They didn't feel great at all. There was a lot of bad news, but those were cheap assets, and over the long term, it turns out that made a lot of money. So we're kind of trained from our days in roaming the Serengeti to focus on the short-term survival. My colleague James Monche talks about we're very poor emotional time travelers, kind of looking for further ahead into the future is very difficult for us. And so this piece is a good way to do that. And I think Nebo Wealth can help there. So Nebo, at our core, goals-based investment platform, connecting the plan to the portfolio, open architecture. But one of the things that I've experienced with Nebo that I think has been particularly powerful is the ability to use Nebo to test my intuition on what a portfolio should be. I might have a clear idea. I think the portfolio should be this much in stocks, this much in bonds, etc. And then Nebo can test your intuition, testing what you need to believe in order to own the portfolio that you do, what you need to believe about the client, their liquidity, their cash flows, their goals, their risk tolerance, and then what do you need about the capital markets. And having a tool like that, what it ends up doing both for the advisor and the client, increases understanding, lowers emotions, and that leads to better decision making over time. The result is you have more confidence that you have the client in the right portfolio, and that we know, Kitsis talks about this all the time, the more confident you are, the faster you can grow your overall business. So as you think about over the next 10 years, U.S. stocks have done really well, taking some of those profits, some of those gains, kind of shifting them into international stocks that haven't done as well, shifting some growth into value. I think is one of those trades that it's not going to feel great at the time, but when you look back in 2035, you'll be glad you did.